Gold has always been a very popular form of investment, and it continues to be so. In India, in terms of the annual value of the investment, gold is second only to real estate investment. What also works in favor of gold is that, over the last couple of years, the ROI on gold has been better than on stocks. With all this information, you must be thinking, alright, maybe gold is the way to go, but is it? Another point of view says gold is not an income-producing asset. In fact, Warren Buffett also echoes the same viewpoint. He believes no matter how you feel about gold, it will never be a true cash flow generating asset. So, what shall we do? Should we increase the percentage of gold in the portfolio, or should we stick with stocks? In this video, we will answer the question for you. Stay tuned till the end to know which one is a better option for investing, stocks or gold. If you're enjoying the content, make sure to smash that like button. Similar amazing content coming up every week. So, let's jump in. We would be comparing gold and stocks based on several parameters such as historical returns, inherent risks, potential returns, and many more. We would also be answering, when is it the right time to invest in gold, how much should gold be a part of our portfolio, and how is gold a useful investment option. Let us understand what gold is first and foremost. Gold is a commodity, which means there is no underlying income-producing asset to it. To understand, compare gold with any other income-producing asset, like real estate or stocks. With real estate you can seek rent every month, it provides income. Similarly with stocks, the businesses are the underlying income-producing asset, businesses have people working for them, they grow, and as a result, the price of the stock goes up. Now, the question is, if gold does not have any associated income-producing asset, then how does the value of gold keep on increasing? The answer is the age-old demand and supply equation. In India, our demand keeps on going up, gold is consumed for various purposes, therefore, the price keeps going up. If the demand was to go down, prices will also go down, and yes, that too happens sometimes. Well, now you probably went from liking gold as an investment option, to being skeptical about it. Hold on, not so fast. Before we decide whether or not to invest in gold, or how much to invest, we need to understand how the purchase of gold happens. There are two fundamentally distinct use cases for gold purchase. First, gold is bought for consumption, like jewelry, it is for us to use. We cannot consider that as an investment, there are reasons for doing so. When you purchase gold in the form of jewelry, there are associated costs like making charges 20 to 25%. The moment you step outside the jeweler's shop, the value of your gold goes down by 20 to 25%. Then there are storage issues. When you buy gold for consumption, you also have to think about where you're going to store it. You cannot store a large amount at home, it's too risky, so the next best option is a bank, which comes with associated costs once again. All that said and done, you have to now deal with impurities. When you buy jewelry, it's usually 22 carats or less, the rest are impurities to add structure and rigidity to your jewelry. All these issues put together clearly indicate that gold purchased for consumption purposes is not an investment. The second use case is buying gold for investment. We can do that in the following 4 ways. 1. Physical gold, not jewelry. We buy this gold in the form of bullion or gold coins. The gold you get is pure, 24 carats, but still, the storage issue continues. To counter this issue, we have these days options of digital gold. The remaining 3 ways are about that. 1. Gold ETF. These work similarly to mutual funds. If a mutual fund invests in stocks, gold ETFs invest in gold. You would need a demat account for this. 2. Gold mutual funds. These are funds of funds. If your ETF invests in physical gold, gold mutual funds in turn invest in ETF. No demat account is needed, but there are some other costs. 3. Sovereign gold bond. These bonds are issued by the RBI, where you can invest. There is a lock-in period of 5 years, and you get a fixed rate of return. Guys, there will be a detailed video on these 4 options separately. Subscribe to the channel, you do not want to miss that video. Let us now understand the pattern of returns on gold versus the stock market. As you can see, in 2020, the stocks go down, and gold goes up. Now is this a coincidence, or is there a pattern in it? Even in 2011, the same pattern can be seen: Nifty falls, and simultaneously gold rises. We can go further back to validate our analysis. The following data is subject to us. As you can see from the table, whenever there is a sharp fall in Nifty return, gold has gone up. 2008 was a year of turmoil, and 2011 was also a year of turmoil, with many European nations feeling the heat, for example, Greece, Spain, and Italy. Then, of course, we have 2020, and we all know what happened in 2020. Once again the stock market fell sharply due to supply chain shocks and global disruptions, and gold on the other hand went up by 24%. So, no matter if it was the global economic crisis of 2008, the debt crisis in Europe in 2011, or the pandemic in 2020, a sharp fall in the stock market is accompanied by a rise in gold returns. The reason for this pattern is very simple: it is safety. Be it 2008, 2011, or 2020, when people feel that their investments are not safe in the stock market, they opt for gold, and as a result, the gold stocks shoot up. Gold is considered a safe investment, and always has been. Back in the day, gold was used as currency. Then governments across the world decided to print currency. Even then, the gold standard was maintained, so essentially governments could only print a limited amount of currency. Then, of course, the governments decided to remove the gold standard because they can, and I don't want to piss off the governments now. So now, currency can be printed as per the government's will. This in turn fuels the issue of inflation rise. In an inflationary situation, the prices of commodities rise, essentially making paper currency lose its value. Gold once again comes to the rescue. You can be pretty sure that even during an inflationary phase, gold will maintain its value and even appreciate. These are the reasons why gold is considered a safe investment. Finally, let us now compare gold to stocks based on our four main parameters. These parameters have a universal use case and can be used to judge any investment options. These are: 1. Returns. In the long term, stock market returns are about 14 to 15%. Gold on the other hand gives an average return of 8 to 10%. As we have discussed, gold does not have an underlying income producing asset, whereas stocks do. 2. Risks. Stocks carry more risks: high risk, high reward, right? Gold on the other hand is not risk-free but has low to moderate risk. 3. Liquidity. Both gold and stocks are highly liquid. You can sell them at your convenience easily. Sovereign gold bonds, however, have a 5-year lock-in period, so they are the exception here. 4. Volatility. Once again, stocks give a high reward but are much more volatile. Gold, on the other hand, has moderate volatility. Even if there is a change in demand and supply, it is usually not drastic. In conclusion, over a long period, stocks have a higher return compared to gold. Stocks have an underlying asset class, which is businesses, that grow, and so does the value of the stocks. So, guys, we have now understood the comparison between gold and stocks, and also understood that over the long run stocks give a higher return. We have seen the reasons behind it and compared both stocks and gold on our 4 parameters. As promised, now I will answer the question: should we invest in gold? And if so, what percentage of our portfolio should gold investment be? Guys, you should most definitely invest in gold. It is a great way to hedge against market fluctuations. 5 to 10% of your portfolio can be dedicated to gold investments, so if there comes a time, similar to 2008, 2011, 2015-16, or 2020, you have a safety net that you can liquidate and use to your advantage. Guys, this brings us to the end of the video. If you enjoyed the video, make sure to press that like button. Subscribe to the channel, and also comment below on the topics you would like to see. Take care of yourselves and your families. God bless us all. Thank you.